Chat with Traders, episode 131, is sponsored by a new podcast brought to you by Walmart. It's called Outside the Box. If you're a maker, a doer, an innovator, or even just a consumer who wants to get a peek behind the curtain of some of the world's greatest organizations, you should certainly check it out. The first couple episodes feature conversations about sustainability and blockchain technology. Subscribe to Outside the Box in Apple Podcasts, Stitcher, or wherever you get your podcasts.
This is your key to the minds of trading's elite performers, those who profit in relentless markets. Here on the Chat with Traders podcast, you'll hear about the skill sets and tactics that lead winning traders to win, so you can level up and become a better trader. Here's your host, Aaron Fifield.
What's up? How you doing, everyone? Welcome to episode 131. Now, you'll recall I had Andy Kirshner on the podcast a few episodes back. Towards the end of that episode, Andy briefly mentioned a cloud-based algo development platform and fund, CloudQuant, which is a subsidiary of Kirshner Trading Group. I mention this because with me on this episode is Morgan Slade, who is the CEO of CloudQuant and has been since 2016. Prior, Morgan's career as a trader and portfolio manager goes back about 20 years, and during this time, he's worked at many prominent firms and funds. Just to name a few, Millburn Ridgefield, Merrill Lynch, Citadel and Allston Trading, amongst others. During our chat, Morgan explains why he feels as though the common approach to strategy development can be counterintuitive, and he gives an alternative three-step formula. We also spend a fair amount of time discussing how machine learning fits into a trader's toolbox. If you are new to machine learning, you'll be fine. Morgan does a great job of explaining things in a way that's easy to follow. All right, intro done. Here's the conversation I had with Morgan Slade. All right, excellent. Well, Morgan, just give us a quick rundown on your background. Tell us a little bit about your history, your backstory in this business. I know you've been floating around for a while, so please share.
Sure. I started out studying engineering, actually, as an undergrad and graduate student at MIT, and there were a lot of people that worked for O'Connor and Associates, which was an options trading shop here in Chicago. That I saw leave the engineering field and come to Chicago and start trading. And as I was finishing up school, that opportunity kind of wound its way down, and Swiss Bank purchased them. But I found my way to New York City and started working for a very old CTA that had been around for about 30 years, called Millburn Ridgefield. And their idea was to train quantitative traders first by training them as traders. And so my first job was actually as an execution trader for a large hedge fund in the New York City area. I spent the better part of the last 20 years or so using quantitative trading strategies and various shapes, both on the buy and sell side, and have been using, things like machine learning and techniques like that for most of that time, and have had the opportunity to trade most asset classes, FX and equities and some options and futures, of course.
I'm interested to know why that first place you worked at, what was their idea or their thought process behind getting quantitative traders to start out as, I guess, more discretionary traders before actually coming across to the quantitative side? What was the idea there?
Well, there's a big jump in terms of understanding how to get your trading algorithms to generate the returns that you think you can based on backtests. A lot of this comes down to what I call trade expression and understanding transaction costs and market impact. When you trade for a firm like that, they had a $2 billion book that was levered up 7 to 8 times. So in the end, they were trading almost $15 billion face value in terms of futures. So as a trader for them, you learn to execute very large transactions A small trade might be, $25 million trade. And sometimes your bigger trades could be a couple $100 million trade in a currency, or, if you're trading futures, these funds sometimes can be trading position limits in a lot of the futures contracts that they trade. Trading that size clearly has a market impact, and you have the ability to see your impact on the market and just kind of internally builds a sense for how big you can trade something and how much you're likely to move the market. And figuring out how to measure the capacity of a strategy is one of the hardest things to do. And so I think that's something that they had in mind when they looked at that. Is, first of all, you need to understand the rules of the market and how it works and how to enter trades, and save yourself from chasing ghosts. And they also felt like by sitting on the trading desk, you generate a lot of new ideas. And so rather than just take what you know from graduate school, they felt like adding that together with a bunch of real life experiences on a trading desk would probably create somebody who was set up to come up with a lot of good trading ideas and trading strategies.
Right. And I think it just might be interesting to hear a little bit more about how you would actually go about executing a $100 million trade. Like, how do you actually put that position on? So, I mean, do you work that over a couple of days? What markets were you trading when you were trading that size? And just speak to us about that a little more, because I think that'd be why, obviously not relatable to most people listening to this, but I think it would be interesting to hear how you actually work a position like that into the market. And also, is it an outright position? Like, how are you actually structuring that trade?
These were outright positions. So you typically have a directional bet that you're placing. And we obviously traded options as well, but most of that was to just gain leverage in the directional bets we were placing. The trades themselves typically were traded through, large broker dealers that had been instrumental in raising capital for us and had, an execution relationship with us through some sort of managed account. And so we would have to take some portion of each trade and trade it through the appropriate counterparty. Because of that structure, it was sometimes challenging to keep things, kind of under wraps and keep them quiet. In some of the, over-the-counter markets, there was definitely, at times a bit of a chuckle on the end of the line when you called the last guy on your list. Of course, the lists are randomized and fair, but the last transaction on the list was usually somebody who knew kind of what you were up to, and just needed to know what size trade you needed to do with them. So that's kind of my experience, trading FX, with institutional counterparties. The next step would be to kind of enter into, the forward swap. We're not taking delivery of the currency, so we would swap it out to a forward date. Usually the IMM futures expiration date, but sometimes other custom dates. On the futures trading side, we usually had brokers on the floor that would be executing for us, and we'd, many times have a direct line where, we would pick it up and it would ring, and we would stay on the phone for them for sometimes hours at a time, kind of working these orders. It would generate a lot of commissions for them, but they also worked very hard for us. Just trying to get that much volume through the market was sometimes difficult. So, there were times where you definitely saw, I remember trading crude oil once, and I kind of felt like I personally, moved it $1 or $2 with the size that I was doing, given the volume that we had to do that day. So, and that's, those are valuable kind of insights to have as you go back to the modeling side, to kind of have a sense of scale. It eliminates a lot of questions that you have, and it eliminates a lot of things that you might try to do that you realize aren't practical.
So were you actually, like, obviously when you want to buy $100 million of whatever that might be, that's broken down into a lot of smaller trades. Where are those smaller trades being executed? Like, I know some people in the past who have come on this podcast have spoken about VWAP, volume weighted average price, is like a institutional benchmark. I mean, I don't know if VWAP is more of was necessarily used, however many years ago this was, but is there a point where institutions like to try and fill their orders, or is it sort of all over the place?
Well, yeah, unfortunately, Aaron, I think you're dating me. Back when I was doing this, people didn't really use VWAP that much. And it wasn't actually until, I joined Merrill Lynch a few years later that I really got involved in kind of helping to write some of the first VWAP strategies. But, for futures traders, algorithmic execution was not something very commonplace at all back then. And I don't really even think it was available. And so, the traders really played a large role in breaking the orders up into smaller pieces and trying to get the best execution they could, for the end investor.
Okay, and just going back to something else you said, you were talking about when you were putting on these big trades that you had to work with like an institutional counterparty. So just help us understand why that's the case. Like, why can you not just put that order into the open market?
Well, for over-the-counter stuff, many times there would be some contractual relationship with a bank that, say, raised capital for the fund. They would be able to ask that we execute, or at least usually execute the orders through their trading desk so that they get some benefit from that as kind of part of the deal. On the futures trading side, for listed products, obviously you're executing on the exchange. You don't have a choice. And so many times they might have their own, floor presence, but a lot of times we'd go through independent brokers on the floor. So we had a lot more latitude in terms of who we dealt with.
Well, let's move this conversation a little bit. I'd really like to talk to you, Morgan, about developing strategies. So we had a call, what was it, about a week or so ago prior to, speaking now and recording this. One of the things you'd mentioned to me is that I guess the quote-unquote normal way of developing strategies to you seems kind of backwards. So I'd be interested to hear a bit more about your process, or I guess an alternative process to approaching strategy development.
Sure, yeah. Happy to go into that. So one of the things that is most frustrating as a trader and as a quantitative trader is, you put a lot of effort into coming up with ideas, trying to figure out what to plug into your model and coming up with some risk rules and how do you cut your losses and how do you take your gains. And then at the very end of the process, you get a little bit of feedback in the form of an equity curve or some sort of Sharpe ratio or some sort of rate of return. And it seems like you went through an awful lot of steps to try and kind of get that metric, that measure of whether you actually did anything right. And most of the time, unfortunately, we don't get it right the first time or the second time or even the nth time. It takes a lot of practice and it takes a lot of blood, sweat, and tears to just kind of find something that actually works. The markets are pretty efficient, and there's a lot of smart people out there. And so after, kind of going through that process for many years, I started thinking about, well, if I start out and I mess up the signaling part of my strategy, then everything else is probably going to fail too. And so I wish there was just some way to break them up into separate steps. And I started thinking about it, and there really is. If you break it up into a prediction step or a signaling step where you come up with some signal that tells you to buy or sell, and then you view the second step as maybe, okay, how big a trade do I want to put on? So we'll call that portfolio construction or risk allocation step. And then a third step is, how do I enter my trades into the market? We talked a lot about how we did it, 20 years ago when I was a futures trader. The world has changed a lot since then. I've actually spent the last, 12 years doing high frequency market making. So I understand how to enter orders into the market now as well. And so the trade expression step is a third step. And really all three of those steps contribute to your P&L. But if you can measure each step along the way as a milestone to see whether you're getting, you're headed in the right direction. It makes a lot more sense in terms of not wasting your time on portfolio construction, not wasting your time on trade expression until you have a really good signal or a really good alpha.
Okay, well, let's flesh out each one of those steps a little further. So you said the first step would be, I guess we could call it the signal step. So what's involved during that step?
Well, for a lot of people nowadays, there's a lot of data scientists out there, people aren't learning machine learning. And so they might look at that step as a data science problem where they want to do some supervised learning. So what that means is they basically label a bunch of examples of their ideal trade, what they would have done if they had the ability to do Monday morning quarterbacking. And then they take a bunch of things that they think might have predicted and been helpful in predicting that ideal trade. And then they do some machine learning to find a rule set based on the inputs as to how to most accurately predict the perfect trades that they gave as examples. And that's basically what supervised learning and machine learning is all about, is identifying what you would do in a perfect world and searching for things that help you predict how to do that in the future. Other people might take, technical indicators and just play around with mixing them up together and different rule sets and different things that, maybe you think a product trades in a correlated manner with another product or a co-integrated manner with another product. So you might take, one leg of a pair of stocks that are highly correlated and you might use one to signal the other. There are lots of different things that constitute a signal, and everybody has their own definition. But at the end of the day, you're trying to predict something, and you're trying to figure out what your win rate is. And so I would focus on, what is my win rate? And I would also focus on the symmetry of, or what the ratio of your average profitable outcome to your average, losing outcome is. And you can do some reading on the Kelly criterion if you want to look at, some gambling theory and how that might inform your signaling process. But at the end of the day, if you have something that pays out, even odds, then the win rate has to be higher than 50% in order for you to make money. But if you have something, as an example, something that pays 2-to-1 odds, say your winners are twice as big as your average loser, then you can afford to have a win rate of just over 33 1/3%. Most people don't really think about it that way, but if you do, and you use a little bit of kind of gambling background or theory to look at your signal, you can realize that it's not just a function of how many trades are winners, but also the shape of the distribution of winners and losers is also very important. So you want things that have what's called a positive skewness, things that have bigger winners than losers typically. And so you could look at Millburn Ridgefield, where I first worked, and they had some surprisingly profitable strategies that had win rates in the 25 to 35% range because their odds of, the odds ratio for their trades, their average profit could be 5 times larger than their average loss. And so I think that's a dot that I connected, after a few years. And I think for a lot of new traders is kind of troubling to think that you can have something that wins less than half the time and it's still okay.
Right. So as we're still on the first step here, which we've labeled as the signal step, is this just the entry, or is this essentially the rules for your full strategy in terms of where you enter and where you exit? Like, where does the signal kind of stop?
I like to make it just the entry. I think it keeps it clean and allows you to kind of fine-tune the exit later on. Okay.
So how do you determine how good the signal is at this point?
At this point, you're looking at the trade win rate. You're looking at the odds ratio or the average profit to loss ratio.
But is that not dependent on where you exit the trade?
It could be. Sometimes you say, oh, I'm going to keep it simple and I'm going to look at something from close to close or from open to close. And so each one of those time horizons that you want to try out becomes a different step one that you need to explore. And so you really, particularly when you're doing the machine learning, you certainly have in mind, when the ideal trade started and when the ideal trade stopped. And so that's really defining your entry and exit conditions.
Okay. And that one-day hold or open to close, is that something you use quite frequently in your own strategies?
Yeah, I mean, we use lots of different time horizons, but very common ones are 1 day or open to close or 2 day or 5 day, holding periods to try and capture kind of medium frequency opportunities.
Okay, so let's say you have a signal which you're happy with. Let's move on to the next step. So the risk allocation step. So how would we move forward from here?
Well, at that point, you want to try and figure out how the best to weight your trades. A lot of people are trading baskets. And so if you have a basket strategy, then you might start out with an equal weighted or naive allocation as a starting point. And then what you want to do is, if you're going to use something like a mean variance optimizer to weight your trades, then or some other type of allocation scheme that you cook up, you want to compare that against that benchmark to see if it actually improves your strategy. There are some diagnostics that you can get into, which is probably too much for this call, but there's a body of work in active portfolio management that talk about looking at the TC coefficient, which measures whether your weights actually are proportional to your alphas in your portfolio or your expected returns in your portfolio. Sometimes when you over-constrain things or you have too many rules that you're adding to your model, so it's too complex, when you try and do these optimizations, you'll actually get very suboptimal answers. And so there are some diagnostic tools that you can use to tell if that's happening and to kind of protect against it. But for a simple strategy where you're trading single stocks and things like that, you're really looking for something that doesn't make any major mistakes and doesn't ruin your alpha, basically. So simpler things tend to work better than not. And in large part, your risk allocation decision has a lot to do with your capacity. And one way to figure out your capacity is by testing your strategy at different sizes over time and trying to get a sense for when the performance is best. There's different size accounts. Some people have retail accounts. Most people do. And so they might be looking at capacity a little differently in terms of what kind of capital they have. But larger hedge funds, they have other capacity problems where they're too big for the market and they need liquidity. So lots of different problems, depending on who you are, will crop up in the second step. One mistake that I think is very common is when people start out with a mediocre signal, many times they'll try and make up for it in their backtest by adding complex stop loss and trailing stop rules that essentially curve fit that particular backtest and make it look better, but aren't actually predicting anything and aren't robust at all. So that when they go out of sample, these same rules that made them look awesome in their backtest end up causing them to be doing really strange things that are suboptimal, and they just don't work. And out of sample, performance isn't what they expected it to be at all. So those are kind of some of the pitfalls for step 2.
Okay, so a couple things. As you mentioned, stop losses just there. How do you treat stop losses in your strategies, and how do you actually think about where to actually place them? Because in some of the strategy development I've done, which is, of course, nowhere near the level which you're playing at, but I've found stop losses to actually decrease performance in many cases. My strategies obviously have a very clear exit rule, so I'm not going to hold a position and just hope that it comes back one day. But there's a clear exit rule, but that rule is generally the same rule that applies for when I take my profit. How do you feel about stop losses, and how have you actually found them to be effective in developing strategies?
Well, sometimes for mean reverting strategies, I found that they've been helpful. But as I've applied, a greater portion of my time to developing machine learning-based strategies, I've realized that what you really want is another machine learning signal or another more complex rule set that's maybe multidimensional, not just looking at your P&L, to tell you when your trade's not working and when the initial, hypothesis you had when you put your trade on, based on new information or some sort of circumstance that you see, set of price action you see in the market or something that you can quantify, tells you that your initial forecast was wrong and it's time to get out and wait for another opportunity to kind of take another bite at the apple. So stop losses, I think you're right. They do decrease performance. They can make your Sharpe ratio slightly better, but they're very hard to get right, and they aren't very robust most of the time. Having traded a lot of different things, I can tell you that there's very few circumstances where just a pure stop loss is the best answer you can come up with.
Now, I don't want anyone listening to sort of take that the wrong way. So I'm not saying, you should be trading without stop losses and just be cautious of your risk.
I totally agree with you, Aaron. That's you've got to use stop losses so that you live to fight another day. But I think that, we can come up with better answers than just, P&L based stop losses.
And on this point, how do you actually measure how good your risk allocation is? Like, is there any sort of gauge to help you decide whether you should move on to the next step or whether you need to, I guess, put a bit more work into how you're allocating risk?
Well, I like trading, Aaron, so I'm usually in a hurry to start trading even if I don't have the best risk allocation scheme. And I find that until I really know my capacity for my strategy, which I can't really figure out until I've traded, although we do have some tools on CloudQuant that allow us to use high frequency data to try and infer those types of things. But generally, the final answer and the final verdict comes from actually trading something. So I typically would choose a fairly simple set of risk rules and take the strategy into the third step and start doing forward testing and doing actual live trading and collecting data on what the impact is. Right.
Well, let's tackle that third step. So if I remember correctly, the third step was trade expression, I think it was.
That's right.
So what exactly is trade expression referring to?
Well, the world has changed a lot in the last 10 or 15 years in terms of execution. Because algorithms are so pervasive, they've automated a lot of the execution tasks on the trading desks, and so what we see now are a lot of the buy side and sell side traders are using algorithms to do their job on a daily basis, and of course they're very productive and they get things done well, and so we leverage a lot of those tools. I've spent a lot of time building autonomous algorithms for market making in the equity and future space. And there's a set of tools that aren't really very useful for anyone else who's not a high frequency market maker, but there's a set of tools that use a lot of machine learning and things like that allow you to kind of come up with a fair value bid ask for electronically traded markets that have order books. And so, in practice, we use that. We have a couple of different types of traders that we work with. We have internal traders that are, typically have a master's or PhD in engineering. And then we have crowd researchers we work with who they may not even be experts on market microstructure and may not understand a lot about it. So we actually, do a lot of that work for them and use our trading expertise to help them get good trade expression on their strategies. And so when they're doing back tests on our system on CloudQuant, they have a menu of algorithms that they can choose from that we have pre-configured for them. And ideally, Aaron, I think a lot of people add the most value in the first two steps. And I think the third step is something that is best left to somebody who's got a lot of market making experience. Or if you don't have access to them, send it to an algorithm that does a VWAP or a TWAP. And if you can't do any of those things, then another thing you can do is you can do something called A/B testing, where you in parallel try to randomly express your trade in a couple of different ways and measure which of the results is best, and then select that as your standard way of doing things. And so that's done by the professionals who do trade expression every day, who do order execution every day. They do a lot of that kind of testing with their order flow, where they randomly, select some of the order flow to do a VWAP as an example, and another to do a TWAP, and another to do an implementation shortfall algorithm. And they're going to try and compare which of those made the most money for themselves or their client.
So this third step of trade expression, is this something which is perhaps maybe more important to traders who are trading much larger size, who can't just put their entire position on with one click?
It is, and it's also more important for people who are doing shorter time horizon strategies, where their edge per share, which I define as dollar profit per share traded, or edge per contract in the future space, is if their edge per share or edge per contract is quite low, chances are they need to spend more time on trade expression to make sure that they actually capture those theoretical profits or that theoretical edge. If you're making 50 cents or $1 a share, chances are you're holding your trades for quite a long time, and you're not as worried about whether you got in at the very best price. So a lot of times it'll be self-determined where you spend a lot of your time. If you're looking for really juicy stuff, you're probably not going to worry about it too much. If you're looking for things that have a really small edge, really skinny edge, then you're going to spend a lot of time doing A/B testing and experimenting with different trade expressions.
This week's episode of Chat with Traders is brought to you by Away. Away make top quality luggage that's designed to be essential to the way you travel. They actually sent me a suitcase. They sent me the carry-on model, which was well-timed considering the handle ripped off my last suitcase when returning from New York. So the carry-on, the one I've got, honestly, you couldn't ask for more from a suitcase. It's designed to be unbreakable, scratch-resistant, has built-in TSA-approved combination locks. It has a nylon laundry bag to separate clean clothes from dirty. But the coolest feature, in my opinion, it has a built-in battery for charging any USB device. Try out an Away suitcase, and if at any point in the first 100 days you decide it's not for you, just return it for a full refund. For $20 off a suitcase, visit awaytravel.com/chat and use the promo code CHAT during checkout. That's awaytravel.com/chat and use the promo code CHAT to save $20. This episode is also brought to you by Men's Warehouse. For Men's Warehouse, this year marks the 10th anniversary of their national suit drive. So during the month of July, you can donate your gently used professional attire at any Men's Warehouse store and give a man a chance to transform his life. If you don't have a suit to give, they're also collecting all kinds of professional items like slacks, dress shirts, coats, etc. All of the donated items will be given directly to non-profit organizations that distribute them throughout the community. To get behind this great cause, here's the link for more info. Now, I'll go slow because it's a little bit confusing. menswarehouse.com, wear as in WEAR, then /national-suit-drive. Okay, just once more. menswarehouse.com /national-suit-drive. Those who donate will receive a thank you coupon for 50% off of regular priced retail items, or you can text NSD to 66960 to receive $10 off your purchase of $50 or more. This might be a good point to ask you. There's one thing I wanted to ask you, and you kind of, I guess, touched on it there. Have you found users who come from a data science background approach trading strategies in a much different way to those with actual trading experience? And if so, how?
The pure data science background folks, they tend to have some ideas as to which kind of tools they'd like to use. But it's like they've got a hammer and they think the entire world is a nail, and they're not really sure exactly how to apply it or which data sets to take a look at. So I found that they pick it up quite quickly, but they could use a lot of mentoring and coaching, and so we engage people through our platform to help them kind of get up the learning curve. And as people kind of stand out and as they look like they're having progress, as data scientists, we actually develop a relationship with them and ask them if there's ways that we can help them. Sometimes I'll give them kind of almost homework or books to read and papers that they might read that are kind of relevant to the problem they're trying to solve, and we'll work with them to help them grow. From the experience trading perspective, a lot of the challenges have to do with many experienced traders have strategies they want to re-implement. And so, but being a little older like myself, many times, the computer science skills aren't there. They might have great ideas and they might be almost able to kind of get them coded up, but maybe need a little bit of help. And so we do spend time, helping people, coach them on how to design their algorithm to plug into the CloudQuant interface, that will allow them to basically, kind of flip a switch and we can get it funded and get it into production. So those are kind of the two different experiences we have. The more experienced people tend to know kind of what they want to do, but I've found that many of them are open to new alternative data sets and things like that as well. They're just different conversations. People have different levels of foundational skills to work with, and but the one thing they have in common is they all like to trade. So,
all right. Well, let's talk more about machine learning. You've brought it up a few times, so I think it might be cool if we could actually dig into that a little deeper and maybe talk some specifics. I mean, I guess just so we don't lose anyone here and anyone who might be new to, trading from more of a data scientist perspective, what is machine learning just at its highest level?
Machine learning is really just kind of an automated approach to identifying the best rule set for identifying something you said that you cared about. And in this case, it's usually, I want to know when I should have bought and when I should have sold. We actually, it's kind of funny, traders have been doing machine learning, but manually for a really long time. It's just an iterative process where you try to basically grow your P&L to be the best P&L you can find. With the advance of, cloud computing and things like Python programming language and, a lot more data, people have begun to share software that allows people to do machine learning pretty readily without really writing very many lines of code. I mean, you can probably do, supervised learning on a data set and build a decision tree or build a random forest model using maybe 20 or 30 lines of code. And all the other code has been written by somebody else who was a domain expert and shared it as open source on the internet. So we're really in kind of a golden age for doing research in that alternative data sets, cloud computing, machine learning, and all these things have come together all at the same time. And so what we've found is there's a lot of people out there who are crowd researchers who do machine learning, and they're kind of leveraging these three things to do a lot of research. Now, how do we do it, or how is a simple form of what we do? Well, we're going to go through and we're going to say, okay, I want to build a decision tree based model, which is similar to the same rules you came up with your technical trading strategies, based on what the RSI is doing or what stochastic is doing or when the crossover moving average is doing this or that. Those rules can be arrived at using a machine learning algorithm. If you take the same things you were looking at and you feed them into an algorithm with examples of what the right thing to do was, it will very exhaustively, in most cases, find the best rule set that you could have also arrived at on your own if you did it manually, but it would have taken you 10,000 million times longer and a lot of sleepless nights and a lot of time. And so the way I look at it is, somebody asked me the other day, with all these machine learning models out there trading with each other, aren't the markets going to become unstable? And my answer was, not at all. The types of models that machine learning algorithms come up with are very similar, or if not identical, to the same models we've been coming up with for 20 or 30 years. It's just that the research process takes much less time. It's maybe 1,000 times faster. And so you can be, much more productive. We see that, in real life. We have people we hire that come on board and start, ramping up strategies within a couple of weeks. We have crowd researchers who are using the platform who, have strategies they develop in, 1 to 2 months, and they look quite good. So I think that it's a great time to be a quantitative trader, and a great time to be a trader, and a great time to be a researcher for these reasons. So.
Now, I know you have a story you can probably share with us about how you took an existing strategy, or someone who you work with took an existing strategy and actually improved it using machine learning. So the strategy was already profitable, was already making money, but then you, I guess, optimized, if that's the right word, the strategy using machine learning algorithms, and actually got the strategy to perform better. Can you walk us through that example and sort of how that all took place?
Sure. We have a quantitative fund that we operate as part of CloudQuant, and we've been adding to our bench of portfolio managers. I found, somebody I felt was, really creative and quite special. He had developed a strategy based on analytics data that he had found somewhere on the internet, kind of an alternative data set, if you will. And he was using it to forecast earnings surprises and disappointments, which is kind of a favorite for a lot of equity traders because there's a lot of volatility, and you can win big and you can also lose big. He had a strategy that had been making about 20% unlevered returns over 3 or 4 years. And I was impressed with the fact that he was a CPA. He didn't have any formal trading experience other than running this fund he was running. He had kind of taught himself how to build this fund, and he'd raised some money from friends and family, and he knew fundamental analysis inside and out because he was a CPA. But other than that, he really had zero programming experience at all. He had never even picked up a programming book in his entire life. He did everything in Excel. And so one of the things I wanted to do was to show that it was possible for somebody with his background, who was obviously very bright, to kind of grow personally and to pick up this new skill set quickly. And so, I kiddingly, told him, all right, well, we're gonna have to, get you up to speed on Python because that's the language for machine learning. And he said, well, where will I start? And I said, well, my daughter Ava is 8 and she has a Python programming book that she uses. I'll borrow her book and I'll get it for you. And he thought that was pretty funny. But he picked it up really within a couple of weeks. He was able to use CloudQuant well enough to start doing backtests. And within 2 months, he had replicated his strategy, and he was starting to do simple machine learning to try and improve the signals. And within about 3 months, he had come up with an overlay to his strategy that allowed him to avoid most of the bad trades that he was getting and really increase the Sharpe ratio to where it went from around 1.5 to about 3.5. And that same guy has now hired several quants to work for him who have a machine learning background. So he has one quant working for him, and he's going to be adding another here pretty soon. And he is in the process of kind of growing his book, and he has now 5 strategies that he's been funded on, and probably a total of about $10 to $15 million in risk has been allocated to his strategies. And he's been here, I think he'll be coming up on just over 6 months. So that's how somebody who may feel like they don't, really have a programming background can pick up and acquire new skills and learn machine learning, which he didn't know at all, very rapidly on some of the new tools that are out there like CloudQuant.
So you said there his strategy went from somewhere around a 1.5 Sharpe to 3.5, which is a massive increase. I mean, a 3.5 Sharpe ratio is very impressive. What actually changed? Like, he used machine learning to improve this strategy. What actually changed about the strategy?
Well, because he started using machine learning rather than having to do kind of that manual, like trial and error type approach, he was able to bring in all sorts of data that he didn't even know. He knew it sort of mattered. He instinctively knew it should matter, but he didn't know how to plug it into a set of rules. And so it just wasn't clear to him how to make it part of his model. So by using, this random forest model, he was able to label all the ideal trades that he was wanting to make and feed in lots and lots of features that he felt like should be relevant. Pick out the 10 or 15 that actually, according to the machine learning algorithm, were relevant, and run a strategy that made a lot of sense to him and was quite transparent. I mean, he could actually look at what the rules are. He could even write them down in English and say, all right, well, when these 5 things happen, then I want to buy. And when these, 9 things happen over here, I want to sell. And so it's nice to use decision trees because they're transparent. And if you use a bunch of decision trees together, that's called a random forest. And it's more robust for some reasons which I don't want to get into. But there are some books that I could refer you to if the listeners want to read about machine learning. They can get Python Machine Learning from Sebastian Roschka. And if they're looking for trading ideas and places to start, Quantitative Trading by Ernest Chan is a very good starting point.
Okay, so is this a fair comment to make? So this gentleman who you're referring to, he had these other data sources which he felt should be relevant. He fed those through a machine learning algorithm, which then determined which of those data sources had any predictive power and sort of discarded the ones which didn't. I mean, is that a fair comment?
Yeah, that's exactly, what you do. So in particular with the machine learning, what you want to do is, you have an initial set of data that you want to do that feature selection on. And then what you do after that is you say, okay, so those are the pieces of information I'm going to use. And you do what's called a walk forward. And you basically, from that point onward, you're not using any more information to change which inputs you have. And you just start doing your predictions. And so, as long as you use a big enough data set to train with, we usually use about 30% of that to train. And then we leave, 70% of that as kind of a walk forward out of sample.
When you're using machine learning algorithms to optimize an existing strategy, just in this example, are there any other measures you need to take to try to avoid curve fitting? Like you said right there, you split the data between 30% in sample, 70 out. Are there any other measures which are necessary to take when you're dabbling in machine learning?
Yeah, I mean, one of the rules that I try and use is that, for every new feature that we feed into the model, every new kind of piece of information we feed in, whether it be a technical indicator or some sort of output from another model or whether it's, some sort of piece of data off the internet that we get from some alternative data source, every one of those, I really want to see like 1,000 independent predictions with good statistics out of sample before I'm comfortable that I've got enough out of sample data to know I haven't curve fit. Because the power to do machine learning is also the power to curve fit. And you have to be very disciplined about drawing a tight confidence interval around your answer if you don't have enough data supporting it. And that data's got to be completely independent of your training process.
Now, just before you used the term features, now this is a common term that comes up when talking about machine learning. Can you just explain what features actually refers to?
So features is synonymous with data inputs. It could be, if I want to build a machine learning model based purely on technical indicators, one feature might be the 20-day moving average. Another might be the distance to the 20-day moving average. A third might be, the distance between a 20-day moving average and a 30-day moving average. All three of those things would be just independent features that may or may not get used by the model. But what we mean is inputs to the model.
Now, a buddy of mine is much more advanced on machine learning than what I am. I mean, I haven't really even got into it too much, but I told him I was going to be interviewing you, and I asked if there were some things which he might like me to ask, or he thought might be worthwhile asking. Just because we've talked about machine learning a little bit on the podcast previously, and I kind of want to explore some new ground. I mean, we definitely have already done that, but just to take things a little further, how do you go about creating features? Is this process automated, or are all the features created manually?
I think in the long run, we'd like it to be automated. At present, I think most people are spending a lot of their time and their creative energies coming up with better features. In a way, the prediction process or the signal process, or the first step, can be broken up into some sub-steps, and kind of the middle of it has been automated by these machine learning tools. And so, as quantitative traders, as creative people, we get involved at the very beginning at engineering the features, and then we get involved at the very end at analyzing the results. And really, the software and the computers kind of do the work in between for us very efficiently. And the ability to kind of iterate on that workflow very quickly, very rapidly, is really how people make a lot of money in this business nowadays, is by being able to rinse and repeat that over and over again. But we, in the long run, aspire to use some of the more advanced machine learning techniques like deep learning to automate the feature creation process. That's definitely something we're very interested in. I think, for the most part, I don't know of anybody doing that. So.
And also another question, I guess, on a similar path here. How do you narrow down the search space to settle on the actual features you feed through your machine learning algorithm?
Well, there's everybody has their own kind of pet way of doing it, but I'll tell you one that's easy to understand and it makes a lot of sense to me. If you were to build a single decision tree, which is really just a simple, one of the most basic machine learning algorithms, what you do is you come up with a set of rules that most efficiently classifies, the good and the bad trades the way you'd like them to be classified. And it does something, called entropy minimization to do that. And that's, in the end, it's just a math problem that somebody else solved for us and we get the benefit of. And so as long as you prepared your data in the standard format and feed it in, it will spit out a decision tree that is just like any other decision tree. It tells you how to classify something. If you look at the things used by the tree and you count how many times one of the inputs was used in creating your tree, you get some sense of the importance of those inputs. And so one of the methods of figuring out which features to use is to create a bunch of decision trees and count how many times each feature was used, and then rank them from most frequent to least frequent, and take the top, X% of those features based on frequency of use.
All right. Well, just before we move off of machine learning here, for some traders who maybe have a little bit of programming experience or are keen to start learning, when they're at a point where they feel comfortable taking on machine learning, if that's something they wish to go into, where's a good place to start? I mean, I know you mentioned a couple books before. Is there anything, I guess, beyond books, like like exercises they could try to do? Do you have any suggestions on where they could start?
Yeah, I mean, I think that, one of the things that you want to do is find some data sets. You can go to Quandl. We certainly have a lot of people who use our data sets at CloudQuant internally and on our farm team to do that type of work. And so you want to find data sets that hopefully nobody is looking at, maybe things that haven't been picked over completely. and you want to create your kind of ideal trades, and you want to, alongside them put all of your features. And then, you want to basically, get the book that I mentioned, the Python machine learning, and, try logistic regression, or try to do a decision tree, or an ensemble of decision trees called random forest. All of those, I think, will be pretty straightforward to set up, and will give you a sense of what it's like to use a machine learning algorithm, pretty quickly.
All right, Morgan. Well, like I mentioned earlier, we have spoken previously. We spoke about a week ago. One of the things which you also mentioned during that call, which just sort of came up when we were talking about Sharpe ratios, you said it's pretty straightforward to be able to get a strategy which has a Sharpe ratio of greater than 3, or maybe even a Sharpe ratio of 4. How do you go about this? And what are the characteristics of a strategy which can achieve a Sharpe ratio of 3 or 4? Because not every that's a specific sort of strategy, isn't it?
Yes, it is. And I think part of it, we have to provide some context. We have a little bit of an advantage with our access to CloudQuant and the high frequency simulation capabilities. I think it should be said that, provided you have access to these types of tools and you have access to interesting data sets, I feel like most of our people that we've brought in, and most of the people we work with on the crowd research side through our research partnerships with CloudQuant, have been pretty successful at coming up with good strategies. So we have, probably at any given time, thousands of users, coming to our free website and starting, to do quantitative research, every month. And we have a lot of people that have, come up with strategies and ask for funding. And so, I guess what I'm saying is, on the basis of kind of my anecdotal experience working with crowd researchers and the new people we've brought on board, we've had good success with people being able to come up with high Sharpe ratio strategies. Now, a lot of times they don't all have the capacity you'd like. They can't trade large amounts of money, and that's really ultimately the holy grail, is to find the $50 or $100 million strategy that also has a Sharpe ratio of 4 or 5 and, has an unlevered return of 20 to 30%. Those are truly hard to find, but there are people finding them. And as we add more data sets and add more tools to make it faster for people to complete step 1 of the model design process, we're finding that people are, increasingly becoming more efficient at doing that.
Okay. Well, I mean, I think probably most people who are listening to this right now would be happy to have a strategy which has a Sharpe ratio of 3 or 4 and be able to run $100,000 through it. So, I mean, you know what I mean? Like, what are the characteristics of a strategy, though, which can achieve a Sharpe ratio of 3 or 4? Because, it's obviously got to be a very short-term strategy. It's got to trade very frequently. Does it have to be, I guess, an HFT strategy?
No, it doesn't. And so the way I look at it is, I look at kind of what I call the Kelly edge. I look at the fair value win rate given the average profit to loss of the ideal trade that we're trying to capture. And I look at the actual trade win rate, and I look at the spread between the two. And I look at how many independent trades can be entered into on a daily basis. And I can then calculate essentially the daily win rate. And so these types of strategies typically win, 60 to 75% of all days, but they may only win on, 51 to 58% of all trades, if that makes any sense. But because you're placing lots of bets, the aggregate power of your edge over the fair value win rate plays out over a large number of trades, just like somebody who's counting, who's counting cards in blackjack, who knows their odds. If you play enough hands, then you ultimately beat the house. And the same thing applies here, is you don't necessarily need to always make money. If you can find something that has a certain amount of statistical edge, where you have lots of opportunities to trade lots of stocks. And this may be the playground for institutional traders rather than more retail traders. But I've seen retail traders who have used our platform and come to us with some good ideas. And so while we don't actually facilitate people trading through CloudQuant, we end up funding their strategies and running it ourselves and paying them a share of the performance. But there are people who, whether they come from a large investment bank or whether they are a really smart engineer or whether they just have always loved trading, they come up with things, and sometimes they're basket trading strategies that have the opportunity to place lots of bets and take advantage of small statistical edge.
So I don't know if this is a dumb question, but how many trades would it need to take? Would you want to take on any given day on average?
Well, I'd like to make as many as possible that I think fall in the category of having positive edge, which may seem like a cop-out answer, but that we really cast a wide net. We try and trade as many different stocks as we can, anything that we feel like we have an edge in.
All right, Morgan, well, let's talk a little bit about CloudQuant, and then we'll probably wrap this up. So just so that anyone listening to this knows a little bit more actually about CloudQuant as a platform, what data is available to users? You've kind of hinted throughout this that there's, I don't know if high-frequency data is the right word, and different types of data too. Can you tell us a little bit about that? Sure.
Well, we do actually have the high-frequency data. So CloudQuant's the world's first free cloud-based backtesting platform where we provide any user who cares to register on cloudquant.com access to high-frequency trade and quote data for all U.S. equities and ETFs. We also provide, kind of the number crunching, the clock cycles, if you will, for free. And we have earnings calendars. We're going to be rolling out news sentiment data, and we have some fundamental data, and we have a number of other data sets in the pipeline that we're adding that will give access to all the crowd researchers. And the way people use that is, we are an incubator for quantitative strategies. I think a lot of people have been challenged with raising capital for their strategies and kind of taking it to the next level beyond what they can fund with their own personal account. And we noticed that with the confluence of crowd researchers or just independent thinking people who are interested in the markets, which we kind of call crowd researchers, and then cloud computing and alternative data sets and machine learning. All four of those things have kind of come together. A few years ago, Andy Kirshner, who was on your show, a few weeks ago, he had this idea that this was going to happen, and he started building a technology platform to allow really anybody to have access to institutional quality research tools. After 5 or 6 years of working on this, we've finally gotten to where it's ready for the crowd researchers to start using it. We've been using it internally to manage about 150 million, and we're growing that number very rapidly now that we've added to our team of internal quants. And we provide this platform for free so that people can push a button that says fund my strategy, and we will take a look at it, compare it against our existing strategies and our years of experience, and try and figure out if we think it's something that has staying power, and allocate somewhere between $250,000 and $5 million to strategies that we think have capacity to handle that. We have other people that have bigger strategies that would get larger allocations, but that's kind of our target area for what we're shooting for initially. And we have probably about 12 to 24 people who are in the process of going through that allocation process right now.
Can you just expand a little more on how you determine which strategies actually get an allocation?
So as we've been trading quantitatively with CloudQuant internally for a little over 5 years, and personally, I've been trading quantitatively for probably 25 years. We have a significant amount of experience with not only how our platform behaves in real life, but how simulations in general perform in real life. And so we do a lot of analysis that's proprietary to help kind of figure out if somebody has, curve fed or done something that's not going to lead to a robust, live performance. So a lot of that, unfortunately, I can't kind of go into, but we do have a methodology for analyzing things, and we had a lot of success stories internally that we can compare things to. We can compare, the Sharpe ratios that we see from the internal PMs, and look to those comparisons as a way to select crowd research strategies. And one thing I want to mention is the crowd researchers own all of their strategies, and it's completely private to them up until the point they decide that they would like an allocation, would like to share in the profits. Then we essentially have a small group of individuals that partner up with them and help them with the trade expression part of their algorithm. And so those people obviously would work kind of hand in glove with them and kind of perfect their strategy for prime time. But for the most part, most users come to our platform and we really can't even know what they're doing because of how it's set up. It's very private. There's a very strict privacy policy, and nobody has access to any of that information. And so the only way we would see their activity is if they're showing up on our leaderboard as having a high Sharpe ratio or a great rate of return. Then we might, kind of give them a pat on the back and see if they are interested in an allocation.
Okay. Yeah. No, I'm glad you mentioned that. It was something I was going to ask you about, actually. Are you able to share what the profit split is? I'm sure some people listening would be interested to know what that is, or does it vary on a case-by-case basis?
Well, it's actually pretty amazing. It's really quite generous if you look at, kind of the hedge fund business and how challenging things have become. Obviously, fees are dropping, very quickly, but expenses are going up, and so management fees are going down. Expenses going up is not the place you want to be. We view, CloudQuant as the first opportunity to generate alpha at scale using those 4 key ingredients that I mentioned earlier. And so we kind of view the crowd researchers as partners in this business. They're a crucial part of the research group. We actually, as of last month, realized that we were doing more research with crowd researchers on our platform than we were with internal researchers on the platform. We have 8 internal portfolio managers. They actually, in aggregate with all their quant trading teams, do less research using the same tools as the crowd researchers than the crowd researchers do in aggregate as of last month. Expect that trend to continue because we have people in 80 different countries doing research actively on the platform, and we are expecting that those numbers are going to grow. So, I think at the end of the day, we pay half of what you'd normally get as an incentive fee. So 20% incentive fee is what a hedge fund typically gets. We pay 10% to the crowd researcher because we value them so highly. And we also create opportunities for them to increase that percentage even further by working closely with us on furthering their research and by achieving high performance metrics.
Sorry, can you just repeat that? It's 10% profit split to the trader?
On the baseline, that's right, of net profit, yeah.
Okay, right. Very good. All right, Morgan, well, let's leave it at that. Where's the best place for listeners to go if they want to find out a bit more about yourself and also about CloudQuant?
Well, I'm not as interesting as CloudQuant, but I refer them to cloudquant.com. And, we have, they're welcome to follow us on Twitter, LinkedIn, and we're constantly posting new updates on alternative data sets that we're adding and new features that we're adding to the platform. We really are there for them, and so we appreciate their feedback and would like to get as many people to take advantage of this opportunity to essentially be our business partners and come up with trading strategies, and hopefully all of us can make lots of money.
That's the goal. What's the Twitter handle?
It's CloudQuant.
At CloudQuant. Okay, cool. All right, Morgan. Well, I just want to say thank you very much for doing this. I appreciate you taking the time. It's been good speaking with you.
Thank you, Aaron. I've really appreciated it, and you have a great day.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.